Chapter 11, Litigation Support in Special Situations. In this chapter, we're going to look at two areas dealing with federal law where accountants could lend a hand in trying to compute damage numbers if any exist. These two areas are the Antitrust Laws and the Federal False Claims Act. So let's get started. Now the Antitrust Laws, you can see here, are an outgrowth of the early years of the industrial age in the U.S., when a small number of powerful businessmen used any tactic at their disposal to force competitors out of business. Well, the federal government did not like this, and of course it wasn't right, and so they passed this antitrust law. Here's where the forensic accountant can come in. Now we talked in the earlier slide about how the accountant can compute damages, but in this situation, the accountant must find out if the defendant had engaged in predatory pricing. After liability has been proven, so again, this is not the accountant's call, but this is the judge and or jury call on this, but once liability is established, then the accountant can come in and find out if there's something called predatory pricing that has occurred. So we're looking for something called predatory pricing. So let's take a look at that. Predatory pricing. This is the act of pricing a product so low that the only logical explanation is that the pricing is designed to drive competitors out of business. That's the only reason. So what is predatory pricing? You can see in the next bullet point, that is, the prices are below average variable cost. Now, as an accountant, you know that if you're not even covering your variable cost, that means for every unit you're selling, you're losing money. You have to cover your variable cost and use that excess to cover your fixed cost and then have a profit. So if you're not even covering your average variable cost, you're not even trying to make a profit here. So that's what predatory pricing is. Their product is priced so low, it is below what we call average variable cost. Now, to find out if it's below average variable cost, you have to look at the cost behavior, and this is not easy to find. These methods you see on the screen now, you probably saw these in your previous accounting courses. The account analysis, that's just looking at the accounts and how they act. The high-low method, hopefully is familiar with you. Regression, hopefully is familiar. And then engineering or work measurement is another method where you get another professional in as engineers to find out how the cost occurs. Now, I didn't cover the fixed cost to variable cost on these slides. Those should be apparent. Mixed cost, this should be familiar to you. I wanted to cover this one formula. Y equals A plus BX. Make sure you know this. And Y equals the total cost. A equals the fixed component of the cost. And BX is the variable component. And so common examples are utility costs, overhead costs, and so forth. Costs behave usually within a relevant range, a certain way within a relevant range. They might be fixed for a while, and they could be, variable. If you look like at the, long range, it could be variable. But within a relevant range, you'll find costs that are fixed, you'll find costs that are variable, and you'll find costs that are mixed. Have a part variable and part of fixed. The time assumption also comes into play. Now, the trouble with trying to analyze a business to determine if they're pricing an item below average variable cost is that if you only look at their financial statements, you're not going to receive that information. Our typical income statement is not set up to show variable cost and fixed cost. It's set up to show cost of goods sold, and then all your operating costs, and then some other income and item, losses, expenses there. And these are not set up in variable versus fixed. It's awful hard to find. So you have to step back and get into the company's numbers to try to figure out what costs are variable, what are fixed, and which ones are mixed. It often leads to experience. Maybe you with your experience in the business world in general, you'll know whether a certain cost is fixed or variable or mixed. So again, you have to dig deeper into the numbers, because just looking at like a tax return or a set of financial statements, you will not know, just by looking there, how the costs act. One method that you've probably seen before is the high-low method. Let's take a look at this again real quick. And let me bring the cursor down here. You take the change in cost over the change in units. The UN stands for units. And so at the 300,000 cost level, that's where you have 100,000 units, and 280, you have 90. So subtract the numerator and denominator. You have 20,000 divided by 10, and so your variable cost per unit is $2. This is for a mixed cost. You're trying to find out what part is variable, what part's fixed. So with this calculation you see on the screen now, we see that $2 per unit is the variable portion. Let's plug that into the numbers. Go back to your, either level's fine, but go back to, let's say now your 300,000 cost level, and that's where we had 100,000 units. So take 100,000 units times the $2 per unit, subtract that from the $300,000, and that gives you $100,000 fixed cost. Now, if you use the 280 here in cost and the 90, you get the same answer. $100,000. So now we have the formula. We have the fixed cost $100,000, $2 per unit, and X will be the units, and this would help us find total cost at any level. So that takes a mixed cost and breaks it down between variable and fixed. And this is sort of a rudimentary way of doing it, but it could be very acceptable. A method might get you even better numbers, let's put it that way, better or closer numbers, would be regression analysis. And hopefully you still remember this from your stats course, and you'll plug in the points, so like let's say the cost according to the number of units, plug it into the computer model, and then you come up with the regression formula. Now regression measures how the independent variable is numerically related to the dependent variable. So that means how changing the value of the X variable affects the value of the Y variable. Correlation measures the strength of the linear association between two variables, X and Y, and it has a value between -1 and 1. Of course, 1 is perfect correlation, -1 is perfect negative correlation. So you'll probably see something in between. The next part we're going to talk about is the Federal False Claims Act. Now, before I get into this, I want to remind you, make sure you go back and read the chapter very well. Back in the chapter, there's a case study. It's the Coho grocery study. That's a very good example of applying the antitrust laws, and you can see how the accountant works through the numbers to find out if it's been priced below average variable cost. So go back into the chapter and read the Coho grocery case and follow it in close detail. Okay, so the Federal False Claims Act. Now, this is set up to protect the government from contractors that are overcharging the government. And whether it's intentionally or carelessly overcharging, it doesn't matter. You're trying to protect the government's money. So this can arise from fraud allegations from audits or other sources, but also someone within the contractor company could be a whistleblower. And that whistleblower could file what's called a qui tam suit. And this is one that the whistleblower, the individual, does file. It's filed on behalf of the U.S. government. And then the U.S. Department of Justice will evaluate the claim and decide whether it wants to take the case itself. It doesn't have to, but it might. And once the Department of Justice makes its decision, the case is unsealed. The whistleblower is known at that point publicly, as well as the alleged issues in the case. Now, the reason an individual might bring this, as a whistleblower, is for financial gain. They can be paid sometimes a % of the amount of the damages, or they might just feel like it's the right thing to do. Now, what can accountants do? Again, you're going to dig into the numbers. You're going to try to find out is, that contractor overcharging the government. When these contractors receive these bids, win these bids and get the contracts will be very specific on what the money can be spent for. And so the accountants, again, will dig through the numbers and try to find out, was the money spent in the correct manner? If not, we might have damages from this Federal False Claims Act. So typical questions: what cost should be included in the contract? How should cost be measured under the contract? What is the correct timing of the cost and or revenues? What accounting concepts apply? And what is the magnitude of damages, again, if any, that occurred because the fraud that took place? Now, in the final slide, it says fraud as defined by the FFCA typically results in damages being tripled. So you might have triple damages here. It may also result in the defendant no longer being able to contract with the federal government. And these triple damages are assessed because they might think, well, we found some fraud, there could be more, and we want to show this as a deterrent to others. In the second point, there still could be damages, but they might not rise to the level of being fraud. If not, the government would claim back those damages, make the person pay, but you probably would not have the triple damages as you would if there was fraud. And then the impact on the whistleblower could be rewards. They're rewarded. I have heard that these are not that common, but there is a possibility the whistleblower could receive a monetary reward. All right, so that's it for this chapter. Again, make sure you go back and read the chapter. There's a lot of detail. There's that excellent Coho grocery store case in here. It shows you how the accountants work through the numbers. That's about it for this chapter, so good luck with your studies.